This thing is going to blow up. Those were Michael Burry's words before the 2008 financial crisis, and he was right. Fast forward to today, and he's back with a new prediction. But this time, it's not just about housing, it's about the entire stock market. The warning signs? Overvaluation, debt, and a tech-driven bubble. If you thought 2008 was bad, what's brewing now could be worse. Could this be the next big short? In this video, I am diving deep into Michael Burry's latest moves, why he is selling US stocks and investing overseas, the parallels to 2008, and why his predictions matter now more than ever. Stick around as we unpack what might be the next big short. Michael Burry doesn't think like most investors. While many chase the latest trends or follow the crowd, he takes a different path, digging deep into the data to find truths that most overlook. It's this knack for uncovering the uncomfortable realities that made him a legend during the 2008 housing crisis. Back then, investors were riding the real estate wave, and Burry was spotting the cracks in the foundation. Now, he's turning that same laser focus towards the stock market. So what makes Burry stand out? He's not one to get swept up in the hype. During the housing boom, he meticulously analyzed thousands of subprime mortgage documents, something few others bothered to do, and spotted patterns that scream trouble. Today, he's seeing a similar story play out. Only this time, the market isn't just propped up by risky mortgages. It's heavily fueled by speculation in tech and artificial intelligence. Burry's latest investment moves, revealed in his last quarter 13F filings, paint a fascinating picture. He's doubling down on companies like JD.com and significantly upping his stakes in Baidu by 66.67%, Alibaba by 29.03%, and Shift for Payments by 50%. This reflects his belief in the potential of Chinese and tech-related companies, areas he sees as undervalued compared to the overheated U.S. market. At the same time, he's completely pulled out of positions in Hudson Pacific Properties and BioAlta, and trimmed his stakes in companies like RealReal and American Coastal Insurance. These moves hint at a strategic pivot, away from sectors or markets that he no longer sees as promising. Matter of fact, only last year, he took a bearish stance on overvalued tech stocks and broader market indices, and actually put money on these sectors going down. His firm, Scion Asset Management, purchased put options against 2 million shares each of the SPDR, the S&P 500 ETF Trust, and the Invesco QQQ Trust, with notional values of $886.6 million and $738.8 million respectively. These ETFs are heavily weighted towards AI-focused giants like Nvidia and Microsoft, indicating that Burry anticipates a market correction similar to the early 2000s tech bubble burst. The financial landscape of last year and this year presents an unsettling paradox. On the surface, markets are thriving, with the S&P 500 achieving a remarkable 23% gain, marking one of its strongest years in recent history. However, beneath this facade of prosperity, signs of fragility are becoming increasingly apparent, and Michael Burry's recent market maneuvers suggest he sees a storm brewing. Burry, famed for that prediction of the 2008 housing collapse, has placed substantial put options against major indices such as the SPY and the QQQ ETF. These bearish bets indicate his belief that the market, particularly the tech sector, is overvalued and poised for a correction. The broader economic indicators add weight to this outlook. Persistent inflation, elevated interest rates, they've created a challenging environment for both consumers and corporations. Corporate debt has surged past $11.9 trillion, and rising borrowing costs have made refinancing increasingly expensive, heightening the risk of defaults, a scenario eerily reminiscent of the lead-up to the 2008 crisis. Recent market performance has been driven by just a handful of tech giants. Companies like Nvidia, Microsoft, Alphabet, and Apple have carried much of the S&P 500's growth, thanks largely to the surge in AI. Nvidia alone has seen its stock price more than triple over the past year, a reflection of the frenzy surrounding artificial intelligence. This heavy reliance on a small group of companies raises serious questions about market stability. When so much growth is concentrated in just a few names, it can mask deeper vulnerabilities, just like we've seen in the past bubbles. Michael Burry's investment moves provide more clues about his perspective. While he's betting heavily against U.S. indices like the SPY and the Triple Q, he's also putting money into Chinese tech firms such as Alibaba and JD.com. This strategy reflects his contrarian mindset, avoiding overhyped sectors while finding value in overlooked opportunities. His actions highlight a broader warning. Overconcentration of market gains in a few sectors or companies is often a red flag. If you remove the top-performing tech giants, the S&P 500's impressive gains shrink dramatically. The S&P 500's impressive performance in 2024 has been significantly driven by the select group of tech giants, often referred to as the Magnificent Seven: NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla. Collectively, these companies have contributed to a 23% gain in the S&P 500, marking one of its strongest years in recent history. This heavy reliance on a few companies mirrors past financial crises, where concentrated growth masked deeper systemic risks. The parallels to 2008 are hard to ignore. Back then, the housing market was seen as untouchable, just as the tech sector is today. But unchecked optimism has a history of leading to devastating market corrections when reality fails to meet expectations. If Burry's predictions come true, the ripple effects could be far-reaching. A sharp drop in tech valuations could drag down the entire market, impacting everything from retirement accounts to consumer confidence. Corporate defaults could spike, leading to job losses and reduced spending, creating a broader economic downturn. Still, predicting exactly when this might happen is tricky. Markets can stay overvalued for longer than anyone expects, and speculative bubbles have a way of defying logic in the short term. Market crashes don't happen overnight. They follow a pattern: overconfidence, wild speculation, and then an inevitable collapse. Michael Burry, with his ability to spot cracks, has flagged signs that we could be nearing another major downturn. To understand his warnings, let's break down what typically causes a crash and why today's market feels eerily similar to past bubbles. Most financial crises begin with a bubble, when prices soar far beyond their true value because of speculation and optimism. In the early 2000s, it was the dot-com bubble, where tech stocks rose on promises, not profits. By 2008, it was the housing market, driven by risky subprime mortgages. Today, the buzz is all about artificial intelligence, with tech giants leading the charge and valuations climbing to record highs. The current AI boom has many similarities to past bubbles. Companies claiming groundbreaking AI breakthroughs have seen their stock prices skyrocket, even when there's little proof these technologies will bring in the profits investors expect. NVIDIA, for example, has seen its stock surge thanks to its dominance in AI hardware. While AI holds huge potential, these valuations seem to assume perfection, an expectation that rarely pans out in industries still finding their footing. Burry sees this overconfidence as a red flag. Another classic crash factor is too much debt, both from companies and individual investors who borrow heavily to cash in on rising markets. Corporate debt in the U.S. is now at record levels, with companies using borrowed money for everything from operations to stock buybacks. Rising interest rates are making this debt harder to manage, increasing the risk of defaults, a scenario eerily similar to 2008 when cheap credit masked deep vulnerabilities until a crash hit. Burry's warnings also point to a troubling dependence on a few big players. In 2024, 7 tech giants, NVIDIA, Microsoft, Alphabet, Apple, Amazon, Tesla, and Meta, accounted for 63% of the S&P 500's performance. That's after they already rose more than 75% the year before. This over-reliance on a handful of companies creates systemic risks. If even one of these giants stumbles, the ripple effects could shake the entire market. We saw this dynamic play out in 2008 when the collapse of the subprime mortgage market triggered a financial meltdown. What makes Burry's predictions so unsettling is his ability to see through the hype and focus on the bigger picture. He understands the psychological cycle that drives market bubbles. It starts with optimism, prices climb, more investors jump in, and the cycle feeds on itself. As valuations soar, doubts begin to creep in, but most people stay confident. Then a triggering event, a missed earnings report, new regulations, or economic stress breaks the illusion, sparking panic and a sharp crash in prices. We've seen this pattern play out time and time again, from the dot-com burst to the housing crisis. Today, that triggering event could come from several directions. AI adoption might slow, disappointing earnings from major tech companies could shake investor confidence, or rising interest rates could push corporate debt to unsustainable levels. Once the first domino falls, the highly interconnected market could see a fast and severe ripple effect. The definite answer is, he could be, but it's complicated. Michael Burry has a proven track record of spotting vulnerabilities that others miss. His warnings about the housing crisis were dismissed at the time, but ultimately proved to be one of the most accurate market calls in modern history. Now, he's sounding the alarm again, focusing on overvalued tech stocks, speculative bubbles in artificial intelligence, and rising corporate debt. The parallels to past financial crises are undeniable, which lends credibility to his predictions. However, markets are inherently unpredictable. Timing is everything in market corrections, and bubbles can persist longer than expected. The speculative frenzy around AI, for example, could continue driving up valuations before the market corrects. Moreover, factors like strong corporate earnings, resilient consumer spending, or unexpected policy interventions could delay or soften the impact of a downturn. Of course, no one's bets are a sure thing, not even Burry's. Predicting the exact timing of a market correction is almost impossible, and the market could defy logic for months or even years. Still, his track record shows his warnings should not be ignored. The risks he's identified, over-reliance on a few tech giants, speculative AI investments, and rising corporate debt, are very real and could have serious consequences down the line. Buffett has also been on a selling frenzy because of the overvalued market. Recently, he also bought some undervalued stocks for his portfolio. Click the video on the screen to find out.